The courses in economics and political science centered on the coming common market. Still, it took over a decade for agreements between the European countries and almost 2 decades before launching the common currency, the euro. While many European countries adopted the euro currency, the UK only put one foot in the door as it refused to surrender the British pound. After 2 decades as part of the European Union, the British pulled their foot out of that door as Brexit ended political and economic ties with the continent. More than the English Channel separated the UK from its European neighbours, divisions between EU members continue to present a challenge for the future. The euro currency has reflected those challenges as it has been in a bearish market for the past 13 years. A long-term bear market since 2008. The euro hit its all-time high against the US dollar in 2008 at $1.6038. The chart of the currency relationship has made lower highs over the past 13 years. The euro versus the dollar fell to a low of $1.03405 in January 2017. After a rebound to another higher low, it was trading at below the $1.13400 level on December 22. The last time the two currencies traded at parity was in late 2002. The euro was closer to the low over the past 2 decades than the high at the end of 2021. A medium-term bear market since January 2021. Meanwhile, the euro has made lower highs and lower lows against the US dollar in 2021. The chart highlights the decline in the euro, with the most recent low coming on November 24 at $1.11863. The 2021 range in the currency relationship has been from the November 24 low to a high of $1.23490 on January 6 as the euro has melted against the dollar this year. The trend is always your best friend. The price of any asset reflects the market's sentiment. Markets move higher when buyers are more aggressive than sellers, and they fall when sellers overwhelm buyers. The crowd's wisdom has created a bearish trend from a long, medium, and short-term perspective when it comes to the euro. Trends are our best friends in markets across all asset classes. The path of least resistance of the euro currency shows declining confidence in the European currency versus the world's leading reserve currency, the US dollar. 3 reasons why the euro could move to parity against the US dollar. 3 factors have pushed the euro lower and could continue to weigh on Europe's currency as we head into 2022. Interest rate differentials are critical for the value of one currency versus another. The U.S. Central Bank accelerated tapering its quantitative easing program, setting the stage for short-term increases in the Fed funds rate as soon as March 2022. With European short-term rates in negative territory, holding dollars versus euros will provide a yield in 2022 while euro holders continue to incur a cost. Holding euros at negative rates involved paying storage for the currency. While political issues divide the US, Europe's problems run historically deep. The euro may be the currency that unites European countries, but the Union's cultural and political differences between northern and southern nations date back decades and centuries. Politics and financial management orientations in Germany, France, the Netherlands, and Belgium are far different from Greece, Italy, Spain, and Portugal. These differences continue to weigh in the euro's value 2 decades after the countries formed a union or common market. Brexit highlights the differences between the UK and EU. However, other member nations continue to have issues with the EU as we head into 2022. The U.S. Biden administration has adopted a strong dollar policy under Treasury Secretary Janet Yellen. The previous administration favored a weaker dollar as a trade tool. Meanwhile, the trend remains problematic for the euro as it has been bearish for years. Currency differentials rarely experience heightened volatility as governments manage exchange rates to stabilize cross-border payments. Therefore, we should continue to expect a slow bleed for the euro versus the dollar over the coming year as the trend points to a decline in the currency relationship. The FXE is the dollar-euro ETF, and the EUO is a leveraged short euro ETF product. The most direct route for a risk position is via the over-the-counter foreign exchange market or the futures arena for those looking for an alternative. The Euro Trust Currency Shares Product, FXE, moves higher and lower with the euro versus the dollar foreign exchange relationship. The most recent bounce in the euro took it from $1.11863 on November 24 to $1.13822 on November 30, a 1.75% move. Over the same period, the FXE product moved from $104.14 to $105.89 per share, or 1.68% higher. The currency markets trade around the clock, while the FXE only trades when the US stock market operates. Therefore, the FXE product can miss highs or lows when the stock market is closed. On December 22, the FXE had $209.460 million in assets under management and traded an average of 37,311 shares each day. The ETF charges a 0.4% management fee. EUO had $55.167 million in assets under management and traded an average of 89,546 shares daily. EUO charges a 0.95% management fee. The double leverage comes at a price, which is time decay if the euro versus the dollar currency relationship moves higher or remains stable. However, on a short-term basis, EUO magnifies the price action in the euro versus the dollar foreign exchange rate. The euro dropped from $1.13822 on November 30 to the most recent low of $1.12219 on December 15, or 1.41%. The chart shows that the EUO product rallied from $25.79 to $26.58 per share over the same period, or 3.06%, magnifying the price action in the exchange rate. Like FXE, EUO only trades when the US stock market operates. The trend in the euro remains lower at the end of 2021. A break below the March 2021 $0.6362 low and the January 2017 $1.03405 bottom could push the euro back to parity against the US dollar for the first time in 2 decades.